So as many of you guys know, markets are currently sitting at all-time highs. And when markets sit at all-time highs, it provides the environment for a lot of companies that do not belong at these elevated levels to do well for a short period of time. And in this video, I wanted to list a handful of stocks that fundamentally have not been performing well. And because of that, I've created a watch list where I've identified 6 of them that I personally believe are overbought and overvalued within the shorter time frames. If you think that I'm wrong and you think that they're good investments, please be my guest. Feel free to buy them at these what I believe to be elevated levels, and we'll let the results speak for themselves. That being said, I'm just sharing my opinion in this video. Again, feel free to share yours down in the comment section. I hope that you learned something new. And just like I'm making videos about overbought stocks, if you guys would like me to, just let me know down in the comment section. I can make a video based off of oversold stocks based off of recent time frames. That being said, let's go ahead and jump right into it. The first one that I want to highlight is TEM, which is Tempus AI. Tempus AI, again, if you guys have not looked into it, Tempus AI is a company that recently gained a lot of traction because Nancy Pelosi announced that she was an investor. By her being invested, again, a lot of you guys know that there's politician trade trackers. They track what Nancy Pelosi and a lot of other politicians are investing in, and they view it as kind of like their edge. Other than that, this company has been a struggling tech company for years. It's a company that loses $200 million net income every single year. It has a negative 75.1 PE ratio. So from what it's valued at to what the company not even makes, what it loses, that's the discrepancy, right? You are paying an insane premium to own this stock at these levels. But again, if you think that it's a good deal, be my guest. Feel free to look into it. When you look into the actual financial models of this company, of Tempus AI, of what they do, the innovation supposedly behind them, there's nothing. There is nothing actually there. It is all fluff. It is all false expectation based off of the narrative that Nancy Pelosi invested, so now we all invest. So when you look at Tempus AI based off of previous levels, you can see that on the day chart, it loves to shoot up and it loves to retrace. It pumps and it dumps, and it pumps and it dumps. And you guys can see the previous pump that we had was right before the trade war, right? And then we implemented the tariffs, caused the stock to sell off. So again, it's always the most overvalued stocks that experience the hardest retracement. And you can see during that retracement, it lost 60% of its value. I understand a lot of companies lost value during that time. A lot of companies didn't lose 60% of their value. And this is just to emphasize that, again, the further you stretch a rubber band that doesn't belong up here, the quicker it snaps and the harder it falls. Now, as it approaches $90 per share, when it comes down to Tempus AI, it's reaching those elevated levels that, based off previous patterns, it tends to get rejected at. Patterns tend to repeat themselves. They don't always have to. Tempus AI, again, still can continue to push up. All I'm highlighting is, based off of previous patterns, it's overbought. Fundamentally, it's overvalued. And technically speaking, there's greater downside risk than there is upside potential. And based off of that, that is why I added it to my overbought watch list. This is not for you to encourage you to short it, because of course, first off, shorting comes out a great form of risk. And second, Tempus AI is a very volatile stock that is not designed for beginners. What I'm here to say is that if you're invested in this stock, I would be mindful of your exposure and your position size at these elevated levels based off previous patterns because of how much it can retrace. The next one we're going to move on to is American Eagle. So American Eagle reported earnings, caused the stock price to skyrocket, and since then, it's been trying to hold at these elevated levels. In this video, again, or in this list, I'm really just identifying stocks that are not just overvalued, but overvalued within a short period of time. And you can see as quickly as it gapped up, now again, it has some retracement potential. The retracement potential based off previous patterns is much greater than the upside. Again, if you look at the actual earnings for AEO, they weren't good, right? Their guidance was fair, but nothing about this said that, well, it wasn't going to be a struggling company moving forward. They used the Sydney Sweeney hype and campaign and said that they wanted to stick to it. And it seems like people just want to support it, and that's fine for a short period of time. Reality eventually will sink in, and this is when the retracements follow. When you look at AEO, you can see that again. It's a company that produces less than $200 million in net income, yet its P ratio isn't anything crazy, 15.8 times its earnings. So out of the ones that I'm going to list today, this is probably the least fundamentally overvalued and overbought, but technically speaking, it's one of the most because it's a catalyst-based event that drove the price up. And every single time that AEO does this, it always gives it back. It always gives it back. So I'm excited to follow up, even if it takes a few weeks from now, to see if AEO holds its ground at these levels, or next week as we enter the FOMC rate decision, if markets do begin to retrace, as again, I believe a lot of it will be influenced by the overall environment of the market. As of right now, because the markets are so bullish, it provides the environment and allows these not so successful companies to trade like they are successful. But once reality sinks in and markets begin to retrace, that environment no longer supports these overvaluations, which is when you see the hardest retracement. So again, very excited to follow up. The next one is Nebius. Nebius, again, went from lows of $64 to highs of $109. It was such a heavily shorted stock that it was impossible to borrow shares to short it. This is not a stock that's designed for beginners, and please, if you've never shorted a stock before, do not short this one. The reason I want to highlight this is if we plug it in, NBIS, you can quickly see that Nebius offers a PE ratio of 113 times its earnings. So it's a company that produces $243 million in revenue, yet it has a market cap of $21 billion. Again, its current valuation and what the company actually makes in net income. Big discrepancy. You're paying a high premium to own the stock as of right now. And if you look at this on the week time frame, this stock has a history of not just doing it right now, but before. It rallies, and again, when did it rally? The last time that we had an incredible bull run that allowed and provided the environment for these bullshit companies to do well. It rallied very aggressively, became overbought to highs of $85, and then saw a sharp retracement to lows of $19.45. If you look based off of the trendline tool, the stock lost about 80% of its value during that retracement. Now, within a short period of time, it's gained a lot of traction, become incredibly overbought, and that's why we're highlighting it. Not because it has to sell off now, because again, market conditions are still bullish. So therefore, market conditions still support irrational valuations. But it's important to create a watch list just so you pay attention, set alerts, and follow up with these overvalued stocks so that once markets do begin to retrace, you have a list of overbought and overvalued stocks that never belonged up there that now, again, get to correct because the overall market environment no longer supports the irrational valuations. So let's go ahead and move on to the next one. Oracle. Oracle reported earnings, causing the stock price to skyrocket to $345 within a very short period of time. This is one of the sharpest pushes that Oracle has seen in a while, 43% since then. We made a video once it started pushing, already calling it out for what it was, and that's overbought. Now it's already retraced 14% and still a lot more downside to go, 30% downside. If you look at this company, again, it's not a company that I would say is terribly ran. It's just a company that based off of recent news based off of recent news that caused the stock price to experience a 45% uptick within such a short period of time that it's just bound to correct itself. It's a company that produces $12.4 billion in revenue or net income every single year, and it has a PE ratio of 66 times its earnings. So again, not incredibly overvalued fundamentally speaking. Its PE ratio is traditionally speaking a little bit on the higher side. Traditional tech companies like to be right around 25. This one's more than double that, right around 66. That being said, it is a company that produces a ton in net income. So fundamentally, it's not a terrible business, right? It's just technically speaking, it experienced a positive catalyst that caused the stock price to overreact for a short period of time. And because of how much it overreacted, now there's retracement potential. So one of two things. If I was invested in Oracle before this report, this wouldn't mean that I would sell Oracle now. Because again, just as quick as it went up, yeah, it could come down, but at the end of the day, my intention was to be invested in the stock that for the most part tends to be bullish. But again, if I'm a trader and I wanted to identify an opportunity to potentially short, this would be something that possibly could meet my criteria because of how quickly it gapped up and then now offers that retracement potential. A stock possibly worth watching if it continues to indicate signs of a continuous downtrend and it offers no break-if pattern for a reversal. The next one is Open. This is the one that I'm most excited about. Open is an absolute terrible company. And it's not just, it's been terrible for quite some time. The last time that it's tried to do well was during the, again, post-pandemic rally, 2021, when it hit highs of $39 and then came crashing down to lose 90% of its value to 51 cents per share. Just 3 to 4 months ago, it was trading at 51 cents per share. And all of a sudden, it's began to skyrocket. Let me make this very clear. Open can still continue to pump up. It's a meme stock. That's all it is. Fundamentally, it's a terrible company that loses money every single year. Something that happened 3 months ago doesn't yield or earn a 2,000% return. It doesn't. That being said, it's a company that loses $305 million every single year in net income. Its PE ratio is negative 21.9 times its earnings. It's a company that, again, has a market cap of $6.6 billion, yet loses $300 million every single year. Make that make sense. So again, it was a shitty company 3 months ago. It's a shitty company now. The only difference is that Reddit traders caught it, right? It's a meme stock. It's pumping up. Allow it to pump up as much as it needs to. All we know is that once again, market conditions no longer support these irrational valuations, these will be the stocks that always experience the hardest retracement. It's not like we're speaking from something that's never happened. It's something that we're speaking from because it's happened before. The other one and the last one that I want to talk about is Tesla. A lot of you guys know that on September 30th is the final deadline for the EV credit for Tesla. That has been a huge incentive in buying Teslas and a huge incentive for Tesla to be earning government subsidies, where it has earned billions of dollars year after year, which it does report in its filings. Now, Tesla after September 30th will no longer be receiving any of these government subsidies. And if you pay attention to its recent price, the reason that Tesla recently gapped up to highs of nearly $400 is because supposedly Elon is done with his political career and returning back to Tesla. So it wasn't like anything changed fundamentally about the stock or the business. It's just that, oh, Elon's back. So let's skyrocket to $400 per share, yet our company is still struggling. If you look at Tesla, and again, Tesla's always been the company that has a good story, right? Because of Elon. I love Elon. He's, I think, one of the greatest minds of our generation. But there's a common saying of people commenting and saying, never bet against Elon. I've made a ton of money shorting Tesla stock. The reason why is that, again, it's knowing when to short and when it's overvalued. As of right now, it still has good price momentum, but there is no question that Tesla has a history of simply not holding well above $400 per share. Just fundamentally speaking, it is not doing well. It's a company with a PE ratio trading at 223 times its earnings, meaning from what it's valued at, 1.25 trillion, to what it makes, nearly $6 billion in net income, there's a big discrepancy. You are paying a very high valuation for a company that produces very little money. And that's with current EV subsidies and credits. Once it loses those credits and subsidies, where do you think that's going to put Tesla? Selling less vehicles because there's less of an incentive, and also receiving less credits, which therefore means less of a net income. Because for those that do not know, Tesla earns so much in government subsidies that they actually offload these government subsidies in the billions to other car manufacturers that need to offset their EV carbon footprint. And because of that, Tesla is able to earn billions of dollars based off of selling those government subsidies. But guess what? It's all coming to an end. Tesla has to truly turn things around. And as of right now, I personally do not believe that it's showing anything in its recent reports that, oh, things are actually changing with Tesla. Its revenue is beginning to decline. Its sales are only going to get worse with more and less EV credits. And with now the negative stigma around Tesla because of Elon's political affiliation, which I don't agree with, right? In the sense of, I don't agree that Elon did anything wrong. All I'm saying is that now people have such a negative stigma against Elon that they will never buy a Tesla. So we'll see. We'll see how things continue to develop for Tesla. Elon has been someone that's been very notorious for seeing through very dark times, right? Especially for Tesla and his other companies. All I'm highlighting is that the reason this stock price went up to $400 is because Elon is returning to Tesla and is done with his political party. We knew that. We already knew that. We knew that his time with the DOGE was limited. So none of this is actually a surprise. In my opinion, it's just an overreaction once again. So just like I don't believe it earned this rally, right, up to $400, that is why I'm excited to short it, because it never earned the push from 350 to 400. So when market conditions no longer support this irrational valuation, I'm excited to short Tesla. Again, something I'm excited to follow up with. So again, you guys let me know down in the comment section what you think. These are 6 stocks that I personally believe are incredibly overvalued based off of recent timeframes. Feel free to let me know down in the comment section that if you disagree with me and you want to buy, let's say, Tesla at $400 because you think it's such a good deal, let's do it. I'll short Tesla with $100,000. Maybe you can decide to buy Tesla at $400, and we'll see who walks out in the green. So I appreciate you guys' time. I hope that earned your thumbs up. Really excited to follow up, and I hope to see you for our live trading session. If you want to see me short Tesla on Monday right at market open, second link in the description down below. We'll hook you up with a big discount for LPP 3.0 so you can watch me trade live every single day. Appreciate your time. Like always, let's make sure that we end the year on a green note. Take care, team.